There exists in the world of speculation a habit so deeply ingrained in the psyche of the losing trader, so deceptively logical in its appeal, that it has been responsible for more financial ruin than perhaps any other single mistake. It is a practice born of hope, nurtured by ego, and executed in a state of quiet desperation. It is the act of averaging down, of adding more money to a losing position, of doubling down on an error in the blind faith that the market must surely reverse and vindicate one's original judgment. This, Jesse Livermore knew, was not a strategy. It was the speculator's most certain path to the poorhouse. He saw this tragic play unfold countless times in every bull and bear market of his long career. A trader would buy a stock only to see it immediately decline. The small initial loss, which should have been taken as a clear signal that his timing was wrong, was instead viewed as an opportunity. The stock is cheaper now, he would reason. I can buy more and lower my average cost. I will need a smaller rally to get back to even. On the surface, it sounds like a prudent business decision, an act of shrewd accumulation. But Livermore recognized it for what it truly was: the first and most fatal step into a bottomless financial abyss. He considered it the most dangerous of all market habits because it directly attacks the one principle that ensures a speculator's survival: the preservation of his capital. The first loss, he always maintained, is the smallest and best loss. It is a manageable, tactical retreat. But the trader who averages down refuses to retreat. He instead sends more soldiers into a battle he is already losing. He transforms a small, containable problem into a massive, unmanageable one. Instead of a minor wound that would quickly heal, he chooses to risk a mortal blow. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The psychological trap of averaging down is built upon an illusion of control. The trader, faced with a loss, feels powerless. The market is moving against him and his capital is shrinking. The act of buying more feels like a reassertion of his agency. He is doing something. He is fighting back. He is not a passive victim, but an active participant in his own financial drama. This feeling of action is a powerful anesthetic, numbing him to the cold, hard reality that what he is doing is compounding a catastrophic mistake. At its core, averaging down is an act of pure, unadulterated hope. It is the belief that a trend that has already established itself in one direction will, for his benefit alone, suddenly and miraculously reverse. It is the substitution of wishful thinking for objective analysis. Livermore knew that hope has no place in the business of speculation. A trader must deal with what is, not with what he wishes would be. When a stock is going down, the fact is that it is going down. The reasons may not be apparent, but the action of the tape is the final, irrefutable truth. To average down is to argue with the tape, a debate no man has ever won. The market is rendering a clear verdict on your initial judgment, and that verdict is, you are wrong. The amateur cannot accept this. His ego is wounded. He is personally invested in being right. So instead of listening to the market's message, he doubles his bet, essentially shouting back at the ticker, "No, you are wrong." This is a form of vanity for which Wall Street exacts the highest possible price. Livermore learned to completely subordinate his own opinion to the action of the market itself. He said, "Markets are never wrong. Opinions often are." The trader who averages down is a man who places his own fallible opinion above the market's infallible judgment. He is a man who would stand on a railroad track, see an express train approaching at 60 miles an hour, and refuse to step aside because, in his opinion, the train ought to be going the other way. The mathematics of averaging down are as brutal as the psychology is flawed. Consider a trader who buys 100 shares of a stock at $50. The stock falls to $45 and he is facing a $500 loss. This is a painful but manageable figure. But instead of accepting this loss, he averages down, buying another 100 shares at $45. He now owns 200 shares at an average cost of $47.50. He tells himself he has improved his position. But what has he actually done? He has doubled his exposure to a stock that has already proven itself to be weak. If the stock now falls just another 5 points to $40, his loss is no longer the simple $500 he started with. He is now down $7.50 per share on 200 shares, a total loss of $1,500. A further decline to $35 would result in a loss of $2,500. The risk has not been reduced. It has been multiplied. The hole he is in has become exponentially deeper, and his chances of climbing out have diminished accordingly. Livermore knew this from his own bitter experience. His most devastating losses, the ones that led to him being completely wiped out, were almost always the result of him breaking this cardinal rule. His catastrophic trade in cotton, under the influence of the brilliant but fatally optimistic Percy Thomas, was a textbook example. He found himself not only holding a massive losing position, but actually trying to support the market, buying more and more as the price fell. He was, in effect, averaging down on a colossal scale. He was not himself, he later confessed. He was violating all the laws that his own hard-won experience had taught him. The result was near total ruin. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis. From the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Seykota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The impulse to average down stems from a fundamental misunderstanding of the nature of a loss. A loss is not a temporary setback to be endured. It is a clear signal that an error has been made. The professional speculator treats this signal with the utmost seriousness. His first thought is not, how can I make this trade profitable? But, how can I exit this trade with the least possible damage to my capital? He understands that his primary job is not to turn every trade into a winner, but to ensure that his losing trades are always small and inconsequential. The amateur, in contrast, becomes emotionally attached to his position. The stock he bought is his stock. He has a vested interest in its success. When it declines, he feels a personal sense of failure, and the desire to see it recover becomes a matter of personal pride. He is no longer trading the market. He is nursing a wounded ego. This emotional entanglement is what prevents him from taking the logical, necessary action of cutting the loss. Livermore was ruthless in this regard. He had no loyalty to any position. He was on the bull side or the bear side only so long as the market's action confirmed his stance. The moment the tape told him he was wrong, his allegiance shifted. He could turn from a bull to a bear in an instant without a moment's regret. He was not there to be a loyal shareholder. He was there to be right. And being right meant accepting when he was wrong and acting on that knowledge immediately. He warned, in his own book, never average losses. Let that thought be written indelibly upon your mind. He knew it was a lesson that had to be burned into the consciousness of any aspiring speculator. It is a rule that runs contrary to our natural instincts. In most areas of life, perseverance in the face of adversity is a virtue. The man who doubles his efforts when he is failing is often praised for his tenacity. But in the stock market, this same quality is a fatal flaw. To double your bet when you are losing is not tenacity. It is recklessness. The market does not reward stubbornness. It rewards flexibility, observation, and the discipline to align oneself with the prevailing forces. The trader who averages down is, in effect, trying to fight the tide. He is pitting his own limited capital and fallible judgment against the immense impersonal force of the market trend. It is a battle he is mathematically and psychologically destined to lose. Each new purchase deepens his commitment to a failing cause, making an eventual orderly retreat all but impossible. He is no longer a speculator, he is a martyr, going down with his ship. For the speculator who has understood the fatal mathematics of averaging down, who has stared into the abyss of hope-fueled ruin, the question becomes a practical one. What is the alternative? If adding to a losing position is the path to the poorhouse, what is the professional's path to prosperity? Jesse Livermore's answer was as simple as it was profound. He did not just avoid adding to his losers, he did the exact opposite. He added only and exclusively to his winners. This was the constructive, wealth-building principle that stood in stark contrast to the destructive habit of the amateur. He called it pyramiding. This was not a mere tactical preference, it was the logical and necessary conclusion of his entire trading philosophy. If a trade that shows an immediate loss is a signal that your timing is wrong, then a trade that shows an immediate profit is a signal that your timing is right. It is the market's own confirmation that you have correctly identified the line of least resistance. The amateur, gripped by fear, is tempted to snatch this small initial profit. The professional, however, sees it as the foundation upon which a great position can be built. Livermore's method was a model of calculated aggression built upon a foundation of proven success. He would never enter the market with his full intended line at once. His first commitment was always a probe, a small exploratory position taken at a critical pivotal point. This initial trade was his test. If the market moved against him, the test had failed, and he would exit with a small predetermined loss. But if the market moved in his favor, the test was a success and the next phase of the operation would begin. He would then add to his position, but with a critical and non-negotiable rule. Each succeeding purchase must be at a higher price than the one before it. He was averaging up, a practice that feels counterintuitive to the bargain-hunting instinct of the average man, but is strategically brilliant. By buying on a rising scale, he ensured that he was always acting in harmony with the market's momentum. He was not fighting the trend, he was joining it, his confidence and his commitment growing in direct proportion to the market's own validation of his judgment. He articulated this principle with perfect clarity in his own book. Let us suppose that you want to buy 500 shares of a stock. Start by buying 100 shares. Then, if the market advances, buy another 100 shares and so on. But each succeeding purchase must be at a higher price than the previous one. This was not just a suggestion. It was the mechanical blueprint for building a winning position. The same rule, he insisted, applied in reverse for the short side. Never make an additional sale unless it is at a lower price than the previous sale. The psychological power of this method is immense. The speculator who pyramids a winning trade is operating from a position of strength. His initial commitment is already profitable, providing a financial and mental cushion. The market is financing his increased exposure. His confidence is high, not because of blind hope, but because he has received tangible monetary proof that his analysis is correct. He is not a gambler hoping for a lucky card. He is a general reinforcing a successful advance. Contrast this with the psychology of the trader who averages down. He is operating from a position of weakness, his capital and confidence already eroded by a losing trade. Every new purchase is an act of desperation, a prayer for a reversal. He is not being financed by the market. He is funding a losing battle out of his own dwindling reserves. He is a general sending his last troops into a hopeless fight. The two approaches could not be more different, and they lead to predictably different outcomes. Livermore's great wheat trade of 1924 is a perfect, large-scale illustration of this principle in action. Having identified a pivotal point, he made his initial purchase of 5 million bushels. The market held firm and then began to advance, confirming his judgment. It was only then, after the market had proven him right, that he made his second commitment, buying another 5 million bushels at a higher price. He did not guess. He did not hope. He waited for the market's own signal, and then he acted upon it with decisive force. The core of this entire philosophy is captured in one of his most famous and profound statements. Profits always take care of themselves, but losses never do. A profitable position, one that is correctly pyramided, is an asset that is working for you. It does not require your constant worry or intervention. Your job, as he saw it, is simply to have the patience and courage to let it ride, to give the trend the time it needs to run its full course. The profits, if the trend is real, will grow on their own. A losing position, however, is a liability. It is a problem that only grows worse with time and neglect. It will not take care of itself. It requires your immediate, decisive action. That action is not to add more money to it, but to amputate it. The speculator, he insisted, must be his own insurance broker, and the only way he can insure himself against a catastrophic loss is by taking the first small one. For the modern trader, this translates into a clear, actionable mandate. If you find yourself in a losing trade, your course of action is singular. Exit. Accept the small loss, preserve your capital, and clear your mind. There is no other logical or prudent move. To double down is to abandon the business of speculation for the emotional indulgence of a casino. You are no longer trading the market. You are trading your own desperate hopes. But if you find yourself in a winning trade, your mindset must be entirely different. This is not the time for fear. It is the time for courage and patience. This is the moment to consider, based on sound analysis, whether it is appropriate to add to your position. Is the trend still strong? Has the stock consolidated and broken out anew? If the market provides a logical reason to increase your line, you must have the confidence to do so. This is how small gains are cultivated into great fortunes. The principle is simple: reinforce success and abandon failure. Yet it is a principle that 90% of traders violate every single day. They do the exact opposite. They abandon their successful trades too early, snatching a small profit out of fear, and they reinforce their failures, adding more and more capital to their losing positions out of hope. This, Livermore knew, was the great tragic inversion of logic that kept the public perpetually poor. To break this cycle, a trader must engage in a conscious and deliberate re-engineering of his own instincts. He must learn that the feeling of fear is appropriate not when he has a profit, but when he has a loss. And he must learn that the time for courage and hope is not when a trade is going against him, but when it is going powerfully in his favor. So when you see a stock you own in decline, do not ask, will it come back? Ask instead, what if it doesn't? Do not try to calculate how much more you need to buy to lower your average cost. Instead, calculate how much more you stand to lose if the downward trend continues. This shift in perspective is the beginning of professional risk management. It is the moment you stop being a hopeful amateur and start being a cautious, calculating professional. The speculator who masters this one concept to pyramid winners and cut losers has solved the most difficult part of the game. He has aligned his actions with the mathematical realities of the market. He has ensured that his profits will always be larger than his losses. He may not be right every time, but his capital will grow because his successful trades will, by design, be much larger and more profitable than his unsuccessful ones. This was Livermore's ultimate secret. His genius was not in some mystical ability to predict the future. It was in his unwavering, almost inhuman discipline to adhere to this one foundational principle. He would not allow himself to be seduced by the false logic of averaging a loss. He would only ever add to a position that the market itself had already blessed with a profit. He was not a bargain hunter. He was a trend follower. He did not buy weakness hoping it would turn to strength. He bought strength, and he bought more of it as it became stronger. This is the true path, the only path to lasting success in the great and unforgiving game of speculation.